Good morning, financial professionals. My name is Shayne Fickling, Regional Vice President with E4 here in the Madison, Wisconsin area, welcoming you to the Brew, building relationships every week. Thanks for tuning in. And for those of you that are tuning in for the first time, welcome. Today we are finishing up August's lineup on Link Benefit and LTC. This morning I am joined by Steve Walker, VP of Institutional Accounts and partner here at E4. We're here to discuss a real success story about an affluent couple who faced the choice of self-paying for long-term care or buying the insurance. Thank you for joining me today, Steve.
Absolutely. Glad to be with you.
So this is a pretty incredible story and one that I appreciate you sharing with our audience here today. At the time, this was, I believe, the largest case that Nationwide had ever seen using their Care Matters Together product. How did this case come to be?
No, it was, and I think we placed it just a couple of months ago, so I haven't heard of anybody beating it. So it's still kind of nice to, as far as I know, still have the biggest combined case there through Nationwide, which is exciting. But it started with one of the advisors that I work with has got a colleague that works with a very successful business owner. So his partner handles the commercial insurance for this individual who owns several different business entities. So the commercial advisor was really the trusted advisor for this client. They've been working together for probably about 15 years or so. And when our advisor that I work closely with got introduced, they were kind of going hand in hand, both the commercial advisor as well as Grant, the executive benefits advisor that does a lot of the life and long-term care and annuity business throughout the agency. So just kind of started as a conversation, actually started as a life insurance conversation with some life policies that they had. But the client just shared that they had some family, it was his parents actually going through a long-term care event. Just talked about the challenges, not only the financial cost behind it, but obviously the physical and emotional stress on the family. So they wanted to discuss a few different options available. Again, we'll do a little screen share here, but client's net worth was north of 400 million. So the commercial advisor, not trying to talk him out of a long-term care plan, just basically said, hey, Mrs. Client, you could self-pay for this insurance for quite some time. It's not going to impact your lifestyle. You could buy a long-term care facility if you wanted to, just to kind of give that option available as well. And the client's response was, why would I self-pay when I can buy insurance? So really opened up the door. He understands the power of leverage and predictability. We'd run a few different options, and then actually it was after a lunch and learn that we had Matt Reddick and Sean Britt from Nationwide in our office here in Fargo. Though both of them attended and just kind of talked about Nationwide has a very large maximum monthly benefit of $20,833 with a 7-year benefit, and you can put a 5% compounding inflation rider on there. So really just kind of building a large pile of money, kind of like we talked about, repositioning some of those shoebox dollars that you're not chasing returns for, just kind of that what if liquid, low yielding dollars to get some good long-term care benefits.
Yeah, and you said something key there, I think, in the fact that the advisor caught the client at a time when they were dealing with it personally with their family. I see so many situations where a client will circle back to an advisor after they've had a health issue, which isn't ideal, or when they're personally dealing with some LTC care situations within their own family. So it really does pay to keep this top of mind with your clients, so that when they do get to the point where they're comfortable talking more about it and are ready for that planning discussion, they can definitely do that.
Absolutely. And I think just like most all the other conversations that we have with the advisors that we work with and ultimately helping the end clients is, it all starts with a plan, and insurance isn't anyone's plan. but it can help fund that plan, whether you're looking, for long-term care planning, income protection, income replacement for life insurance, but just really starting that dialogue. And again, it was unfortunate that it took a family event of the father needing care. But again, it got them thinking about not wanting to leave that financial, physical, and emotional burden on their kids.
Yeah, absolutely. Before deciding to go with Nationwide, what other products or planning concepts, were discussed with the advisor? You talked a little bit about some other options that you took a look at. I'm just curious what those all involved.
No, it really started with conversation, talking about the plan. Initially, it started with our long-term care analysis that all the advisors have available to them. That really just talks about long-term care planning in general, and then it goes through the different. Here's what self-paying is going to cost you. Here's what you've got to set aside. Here's traditional long-term care and the pros and cons of that. The asset-based long-term care, like we placed with Nationwide and some of the other carrier partners that we have, as well as life insurance with an accelerated death benefit for long-term care, chronic illness. So really start with that conversation, got the client to understand the value in some sort of insurance because of the tax efficiency, the predictability, and really the leverage over the self-pay. And they just really dialed in and liked the option of, if they don't need it, then at least they're going to get what they paid in premiums going back to their heirs. So they really knew they wanted to go with an asset-based approach. We looked at all of our different carrier options, and they each had different pros and cons, but the client ended up really liking the large pool of money with Nationwide. With that, again, we'll look at some numbers here in a bit, but a 7-year benefit and a 5% compounding inflation rider can really make that pool very large, very attractive.
Yeah. And if I recall, these are our younger clients, relatively speaking, when it comes to LTC planning. More and more of our advisors should probably be talking to their clients when they're in their early to mid 50s. I know the industry is slowly kind of shifting towards awareness around age and trying to do some planning while they're still younger and healthier. Do you want to just share the client profile sheet that you've got on these kind of clients?
Absolutely. And this is right on our website. When you log into E4 and go into the marketing tab, search under long-term care and LTC linked benefit. But yeah, just I would agree with you. Obviously, when you're buying the insurance, the husband was 57, the wife was 53. So again, they're at that age where they still have their health. They actually flew through underwriting. We got a very quick decision from Nationwide on these. I think within 48 hours on both of them. Once the applications were submitted and the phone interviews were done. But again, net worth about 400 million. So again, when you're in your 50s, you still have hopefully as good a health as you're going to have, before getting into your 60s and 70s. So that leverage you can really get is just enhanced all the better. But talks about the plan that they wanted to achieve. Again, they wanted to be able to receive care where they want it. Whether that's in their own home or if they need to go to some professional facility if they need to. Not need to worry about what assets are they going to need to sell if they need care. Because again, by planning early with insurance, they can reposition some of their low yielding liquid dollars. They didn't want to pay insurance premiums for the rest of their lives was another big thing. And then that last bullet point, like we talked about a minute ago, if they didn't need care, at least having their money back to their loved ones if they don't need it. So as we stroll down here, again, one of the three big things I think with insurance, especially with long-term care, is you get leverage, tax efficiency, and predictability. So again, the predictability factor was big, the tax efficiency was huge, but really it was the leverage and what they get on their dollars. Because again, each spouse, they bought a policy that started with a $20,833 monthly benefit. The maximum Nationwide will offer. They did a 5% compounding inflation rider. Again, the highest that Nationwide will offer, and they did a 7-year benefit period for each spouse as well. So again, when we look at the husband who was 57, they decided to go with a 10 pay, rather than single paying it, so they can keep their money at work and other investments and endeavors, but paying it up over 10 years, so they weren't paying forever. Husband's premium a little over 60,000 a year, so he's all in for 604,000 roughly. And the wife, who was 53, about 87,425 was the annual premium, so just shy of 875,000 all in over 10 years. So a little bit under $1.5 million premium all in over 10 years. You can see if they don't need it, they get their money back in the death benefit. But day one, once that husband wrote that first check, his long-term care pool of money was over $2 million. And when he's 85, with that 5% compounding inflation, that's almost $8 million that he has available for long-term care should he need it. And with the wife at age 53, similar, again, that same $2 million pool, day one, and at age 85, north of $9.5 million if they needed long-term care for that pool of money. So you've got almost an $18 million pool of money that cost 1.5. So again, that leverage and the power that provides really just, again, reposition some of those liquid, low yielding dollars if they needed long-term care.
Yeah, it's incredible leverage. And kind of to your point, they're repositioning other more highly taxable, lower yielding assets where worst case scenario, if they both die peacefully in their sleep at night and never use a dollar of the long-term care benefits, they've got a much better tax-free benefit that's passing along to their estate or to the kids or whatever.
Absolutely. And again, we don't know what the cost of care is going to do, as we continue to move forward. But again, right now, around here, I mean, 20,000, that's per month is going to get you a heck of a good amount of benefit, and in talking with Dan Peterson, our president, he kind of referred to this as the never go into the nursing home insurance. I mean, again, you've got the liquidity to ideally and hopefully be able to pay for somebody to come into your own home, and you can be in that comfortable spot as long as you need care. And
Absolutely.
not rely on kids and grandkids and put them through those types of issues. Nobody wants to help with their parents. No parents want their kids, doing those types of things for them and putting their lives on hold. So it really just was a well-rounded kind of putting that fence around their overall financial plan.
Absolutely. I'm just curious, you started the conversation by talking about a review of some life insurance that the couple had initially. Has this since led to any other estate planning or, leveraging of life insurance dollars for any potential estate taxes upcoming?
No, it certainly has kept the conversation going. The insured is believes in insurance, obviously, and clearly there has some life insurance in place. But they really were focused on making sure they got the long-term care aspect handled first. But again, the conversation for some liquidity for estate taxes and those types of things are certainly ongoing, and expect some more opportunities from that front in the coming months.
Right. I'm curious, there always seems to be some stumbling blocks along the way with larger cases like this. What challenges did you and the advisor face as the case progressed through underwriting, either from an underwriting or a funding standpoint when that check actually had to be written?
It was actually, all things considered, it was about as smooth as it could have gone. We were very lucky. Both husband and wife were very healthy. It flew through underwriting, like I mentioned. Matt Reddick and Sean Britt and the team at Nationwide that we work closely with really did a great job of shepherding that, right through the underwriting process. So we didn't have to worry about any paramed, didn't have to get APS records. So, luckily, and again, kind of like we talked about earlier, when you do this, when your health can afford it, and you don't have those dings in the medical records, it can certainly fly through a heck of a lot smoother. So if you've got everything, in a good spot and you're able to take this on earlier rather than later, certainly can make it smooth. From a funding standpoint, I think the client really was just kind of more so joking with the advisor when they went to deliver it and collect the check, and just said, "I bet you really want to have this check coming your way," and had it sit right there in front of them, and was more so just having kind of a joke, because again, the income, the premium dollars wasn't necessarily the issue for this client. It was really just truly reallocating some liquid dollars to get that leverage. So definitely a fun opportunity, fun sale, and most importantly, a couple of clients that really solidified some protection within their overall plan.
Absolutely. I'm guessing that that this may have been an eye opener for Grant as well. I'm sure he doesn't have clients like this that come into his office every day or anything, but has this changed his mindset as far as looking for other clients that may be good prospects for the same or similar types of products?
Yeah, I think it's certainly, I think, Grant has always, always been a planning mentality, not a transactional advisor at all. I mean, he certainly wants to look at the overall picture of all the clients. So I will give him a ton of kudos. He does a great job of not just selling stuff to his clients, but really doing what's in their best interest, whether that's insurance or not. But I think what it did, for a number of people that have heard the success story already, is again the mindset of somebody worth $400 million, or for that matter, $10 million, $50 million. I mean, high net worth individuals. There is certainly value in this type of long-term care planning, because wealthy people don't get there by spending money haphazardly. They look and say, hey, where can I get leverage? Where can I put my money to work? So when you can see, hey, I can put in $1.5 million and have $18-19 million if I need care, that's pretty darn good return on your money for some shoebox money. So again, little bigger shoebox than what a lot of people have sitting around for liquid cash. But again, even if you look at that in a smaller dollar amount, the numbers won't be exactly the same, but the leverage is going to be consistent when you look at that internal rate of return on what your premium dollars are compared to your long-term care pool of money.
Absolutely. And how about for you? Has this case changed your outlook in any way when coming across high net worth individuals and their advisors?
Yeah, I mean, it's always a fun market to work in, obviously, because again, you're seeing some larger case opportunities. This is obviously a great case for everybody involved. Again, first and foremost, start with the client to make sure they're protected and properly taken care of. But again, I think it's just a great reminder for myself and for everybody on our team, all the advisors that I work with, is, don't shy away from having that planning conversation. Again, whether somebody's worth, $5 or $500 million, there may be some opportunities that you can really have those conversations with. I know internally we talked, we had a colleague that had an advisor pass away, a young individual, had a $6 million term policy payout. Again, that's meaningful dollars for those clients, and really taking the financial stress off of the family. You can't bring back a loved one. We've seen death benefits paid. We've seen these long-term care claims being paid. And that's really what we all get into it for, making sure the clients are taken care of. But yeah, I think that was the biggest thing that opened my eyes is why would I self-pay when I can buy insurance? When you see that leverage it gets.
Yeah, that's great insights. And I think you hit the nail on the head with talking through the benefit to the team and being able to share this concept, SVP being able to share his story over the last couple of weeks. It just helps us all to be better and stronger partners to our advisors as well.
Absolutely. And again, we're certainly carrier agnostic, and we were going to put the best solution in front of the advisors that we work with, for your clients. But again, having Matt and Britt Matt and Sean from Nationwide in person, doing a little lunch and learn. They were great to work with, and can't thank them enough as well for really making this a smooth process for the clients as well as our advisor.
Yeah, we rely on our carrier partners all the time and every day to come through and to meet us with the promises that they have on the back end, and they do a great job of that. Well, with that, as we wrap up, I want to remind everybody that today's brew and all of our brewcasts are recorded and shared on our brew page on the E4 website at www.e4.insurance. Don't forget to subscribe to our YouTube channel to keep up with all of our brewcasts. They're released every Wednesday at 10 a.m. Central. Next week's live brew will be held at 10 a.m. Once again. We're kicking off our September lineup in recognition of Life Insurance Awareness Month with our MVP, Jeremy Vidmar, Regional Vice President here at E4. He'll be joined by Greg Spaeth, Chief Strategic Initiatives Officer, for an in-depth discussion on understanding IRS Section 7702, Strategic Opportunities for Advisors. Thanks everyone for tuning in today. Thank you, Steve, for your time and for joining me. If any questions come to mind as a result of the session today, or if you thought of a client that you should be talking with more about a concept like this and would like to brush up on a few things prior to approaching them, please reach out to your RVP. I hope you enjoyed today's session, and we will see you next week on the brew.
Shayne, thanks everybody.